Okay, welcome guys. This is the SPX Credit Spreads and Futures Workshop. We are going to be covering a lot of material today, so just be sure to be able to take notes. Okay, a little housekeeping. The webinar is pretty packed, so what I'd like to do is hold all the questions till the end. If you could, take notes, and I will stick around to answer every one of your questions that you have. Okay. All right. So let's get started. This is a live webinar. Just letting you know that I'm here in Florida, soon to be going back to Puerto Rico. And so let's get started. Okay. The first thing we're going to talk about is what to expect today. Okay. So today I'm going to show you how you can make consistent returns monthly based on margin capital at risk using high probability trades. Okay. And even the trades that are not high probability, like futures, I've worked long and hard to get those high probability as well, and testing that strategy for 8 months now, and it's raring to go. Okay, so let's get started here. So what are you going to learn? Today you're going to select the right option credit spreads before the market opens. That's for 0 DTE. Okay, we're going to talk about entry, exit, all those things regarding a trade plan. Okay, how to enter and exit your trade, how to prevent large losses, which is very, very important, and have a general understanding for when not to trade, and how to trade consistently profitable. All right. I want you to hang in there till the end. We have a special bonus, and please stick around, and it's really important and you don't want to miss it. All right. Okay. So this is the time you want to take care of all the distractions. All right. And there will be a replay that you're going to get tomorrow of this session. So, but stay live here, take notes, and you try to get as much out of this thing as you possibly can. All right. So let's get going. All right. So the first thing we're going to talk about is why the heck you're here, right? Number one, and I jotted down 3 reasons why I think you might be here, and I think I'm pretty close to that. All right. So if you're interested in learning new strategies that'll take your trading performance to the next level, so you can finally leave that 9-to-5 career behind, right? I did it, so you can too, right? You've seen, heard about, read about making money trading, okay? But you can do it too. You just haven't seen your account grow. That's another reason you may be here. And the third reason is you've tried different trading strategies that you thought, okay, this is it, only to discover that you're just not getting that place of consistency in your trading results, right? So if you fall into one of those categories, let me know, just so I know you're alive, right? So all the above. Yeah, and I spent many years in all the above category myself, 2 and 3, great. Thanks, Tim. Okay. Anyone else? Right? Okay. Hopefully you are awake and ready to go. Okay. Here we go. Okay. I'm a normal guy, with a normal family, as normal as can be. That's me and my wife on the left, living in the dream life in Puerto Rico. Love it there. There's 4 or 5 of my kids, and that's my youngest son's Marine graduation about a year ago. And then on the right, that was my parents, and that was when I got my executive MBA, when I was in the rat race career field, IT. All right. Okay, so I want to start by just thinking about or imagining what it would feel like, right, if most of your trade were winners month after month, and it would be confirmed by watching the size of your account grow at the same time, right? Think about that, okay? In addition, becoming the trader that no longer takes large losses but consistently trades according to a proven trade plan, and that's very, very important. We're going to talk about trade plan today. Okay, and making that profitable over time, allowing you to grow your account month after month. Just think about those things, focus on them. You know, trading is a state of mind that you need to get into, and you need to be positive, confident, and you know, take this thing and move it forward. Okay. So so let's talk about the nitty gritty of the SPX credit spread first. All right. So what is it? Credit spread is a combination of two puts or two calls where the put or call that is sold is more expensive than the put or call that is bought. Okay. And that creates a credit, right? So so this is a actual trade. Okay. And so what you're doing here is you're actually selling the 3010 put and buying the 3005 put, and you actually receive a credit when you put on that trade, and that's called a bull credit spread, right? Yes, selling the 3010 and buying the 3005, right? And so this trade is considered to be high probability. And why is it high probability? Well, number one is that you don't have to be exactly right about the market direction, and I'll share, you know, a couple of real examples of that of that being the truth. Okay. And the option premium deterioration works in your favor. And so there's different ways that the premium of that option when you sell it deteriorates, and we'll talk about that too. All right. And those are very important to understand. Okay. So the bad thing about this trade is that the risk reward is pretty poor, right? So what you're doing with this trade is that you're actually gaining a 45 cent, and you multiply that by 100 by one contract, right? So each contract is worth $45. The risk reward is basically that you can lose $5,000 minus the credit based on the reward of $450. It's just a fact, okay? And because of that, it has to be managed correctly. So the max loss is $5,000 minus the credit. Okay, and that's also your margin requirement. Okay, so that kind of takes care of the ABCs about this particular trade, right? And again, you know, save your questions to the end, and I'll answer them for you. Okay, so let's talk about option decay, and this is a real example of call options on the S&P 500 and when and how they decay, basically. Okay, so from 68 to 33 days, the rate of decay is 34%. Okay, and that works for monthly options. The next range is from 33 to 5 days, right? And the rate of decay is 57%. And then finally, at the end, from 5 days to expiration, the rate of decay is 100%. And so the decay increases in velocity, right, as the number of days go by. And so you know, if you look at the 5-day expiration, that's what makes, you know, the 7DTE really just a phenomenal trade to trade, and I'll share some examples of those as well. Okay, so let's talk about profitability factors, and there actually are three, right? The first one is implied volatility. So in an ideal setup, you want to sell options when volatility is higher and moving lower, right? And actually that you know, that volatility decreases, and it also erodes the premium, okay, after you put it on. Okay, the next one is theta. Theta is actually it's one of the Greeks, okay, and it measures the rate of decline of the value of the option due to the passage of time. Okay, big factor for 7DTE, just because, you know, it decays 100% during that last period of time. And then the third is actually market direction, right? So if you have a market trending away from your position, it'll cause the premium to drop. If you enter the trade and the market moves against you or in the direction of the credit spread, you'll see the premium price increase significantly. But as long as it stays within the acceptable range, it will remain profitable. Okay, and that's what I was talking about. You don't have to be exactly right, but you have to make sure that the market stays in that range for that period of time that your option is alive, right, and not expired. Okay, so really important is risk management, and I want to emphasize that because it's probably the most important part of trading, and I'm sure you're all aware of that. All right, so always trade with a plan, right? Number one, you always want to trade with a plan. And, what's important is to understand entry, exit, trade size, composition, and when not to trade, all right? Secondly, you want to determine what your max loss is and your risk reward before entering that trade. So I say no more, trade no more than 20% of your credit margin, right? Based on the total trading capital. You want to leave room for drawdowns in case you need to adjust those positions, right? So you need to leave a lot of room in your account so that you can manage it correctly, okay? You don't want to allow more than a 2% loss based on your trading capital. Some people use a 1% loss, all right, on there as well. So you want to make sure that your losses are small, right? In a highly trending market, position trades to follow the trend. You don't want to be a hero, right? If you've got a clear trending market, follow that trend. It's the easiest way to go, right? And then never hold short-term credit spreads overnight. And when I say short-term, what I'm talking about is 1 to 2 days, and actually 1 to 0 days. That's why I don't like options expiring on a Monday. And the reason for that is because it's Friday, right? It's 3 days before the option expires. But then when you reach Monday, you could have a market, trending in one direction or another strongly, and you can't do anything about it. You're in a 0 DTE situation. And so I don't like to allow trades to expire on that on those Mondays, just because I want time to be able to manage them. Size your trades to ensure that emotions are not part of the decision-making process. I always say trade small, trade often based on your account size. And the reason for that is because you make different, I can assure you, and I'm sure you've lived through this, you make different decisions when you're trading big and you need to make a decision to get out or stay in, because the amount of that loss is emotionally binding to you, okay? It's strong. So keep that in mind when you're trading, and it's very, very important. So trade small, trade often. So you're always in that rhythm of trading and practicing. It's just like any other profession, okay? But you want to be in a position that you're not making emotional decisions, but decisions based on a trade plan, okay? So pre-market routine. I have a pre-market and post-market routine. So I always review the areas of support and resistance, especially for 0 DTE, where they are, where they form. And we'll talk a lot about that in the session here, okay? I look at the US dollar just because it really is affected by the price action in the SPX, just because over 40% of companies are multinational and depend on, foreign currencies to gain their revenue, all right? So it really does affect S&P 500 companies. I review treasury rates just because treasuries always compete with stocks. And so when treasuries are low, there's less competition. Money flows into stocks. When treasuries, treasury rates are high, money starts flowing into treasuries, taking away the actual money from stocks. Okay, right now it's just, there's no way to go. There's no other place to go except in the stock market, because you're getting 0.5% return on treasuries. All right, review ES. ES is the futures instrument for the S&P 500, and so it trades from 6 p.m. on Sunday, 6 p.m. Eastern on Monday, until 5 p.m. on Friday. Okay, so you want to follow that on the overnight, and it actually establishes support and resistance from the overnight that you can take into the regular trading day. Okay, the VIX, that really is the volatility for the S&P 500. So I always have that chart in front of me and looking at where those VIX levels are. Implied volatility is very similar, all right? And there's an indicator in TOS in Thinkorswim that you can use for implied volatility, but they're always the ratio is the same. It's just a little bit different on each. Okay. And then, as I mentioned, determine your credit spread positions, and I save them into my my phone before I trade. So I know which positions I'm going to choose from and put those trades on very, very quickly. Okay. So let's talk about post-market routine. Number one, I determine if rules were broken and why. Okay. And it's really important to understand that. Okay. Determine if risk was within acceptable levels for wins, especially for wins. Just because what happens is that if you take risks that you shouldn't take based on your trading plan, what happens is you become complacent. Okay. Once you become complacent and say, oh, I can do this again and again and again, right? Oh, it breached the position, but it came back up, so I'm golden, right? I got out for max profit on it, right? Well, I can tell you from experience that there are going to be days that you're going to breach, those positions, those credit spreads, and the market's going to keep going and it's not going to stop. And it doesn't happen often, but it happens. And that's when you take that huge loss that really debilitates you as a trader. You don't want to be in that position. Determine if losses were within acceptable levels. You don't want to have small losses consistent, because that means there's probably fear in your trading, right? You don't want to lose, but you also don't want to make big losses either. All right. So fear is not good. Greed is not good. You want to have a balance between them. Always determine if tweaks or adjustments to your trading plan is necessary. Markets change, you change. So you want to go back and make sure that your trade plan is relevant. Okay, I do this every 2 to 3 months. I go back and look at it and determine to make changes, right? And a lot of times I do make changes to my trade plan and keep it updated. Trade journal is important just because you want to track your wins and losses and your gains and losses. All right, so keep a trade plan and take notes on it, what you did right, what you did wrong, and it makes you a more proficient and more powerful trader. All right. All right, so let's get into the nuts and bolts of each strategy. I have 4 strategies for you: 0 DTE, 7 DTE, and the monthly, and also futures. And so I added that this year to my trading repertoire. I do that. I trade futures almost constantly. In fact, I'm in a position right now, okay, that I'm trading. And no, I don't have to be looking at my screen to do it, because I mostly do swing trades on futures. All right, so before we get into the day trade, construction or trade plan, let's talk about pattern day trader. Okay, if your account is under $25,000, you're subject to day trade restrictions. And what does that mean? It means that for a day trade, the buying and selling or selling or buying of the same security in the same day that the trade is initiated means it's a day trade. And you have up to 4. You have up to 3 trades that you can trade. You go 4 or more in a 5 consecutive day period. What happens is you can get restricted on your account to only sell positions that you're holding. Okay. Okay, so what can happen if your count is below? Yeah, just what I mentioned. In selling position, you can only sell positions. All right. So how do you avoid being flagged, right? On your trading account. Limit trades to 1 trade 3 days a week. So if you're trading 0 DTE, trade Monday, Wednesday, and Friday. Trade only 1 trade, and you can actually close that trade and do it on Monday, Wednesday, Friday, and you will not be restricted to, by PDT. Okay, that's one way to do it. The other way to do it is manage trades for multiple accounts. So you can alternate between accounts, right? And you have double the amount of day trades that you can do. I know people who use 3 accounts that do it this way. You can trade wider iron condors and allow them to expire. Okay, and I know a lot of traders who do this too. They use 15, 20, up to even 50. They let them expire most of the time, right? And so that's just another way of trading. Or you can trade ES future spreads, right? There's options on futures, and they're not subject to PDT. Why that is, I have no idea, because it's basically the same thing that you're trading, but they're not subject to PDT. and neither is trading futures themselves. You know, you can go in and out 100 times a day on futures, and you're not going to be ticked for PDT. Okay, with an account that's under $25,000. All right, so let's talk about entry and exit for 0DTE. Right, so enter within the 5 to 10 minute market opening. And why do I do this? Because volatility is at its highest point during the first 5 to 10 minutes of the market open. Okay. And so, and you'll be, you know, once you start trading 0DTE, you'll see this clearly when it happens, because the market will go and it'll move in the first 10 minutes, and your premium will actually decay in that time, even if the market may be moving against you slowly, let's say. Okay. You can use up to 5 wide to 15 wide spread. 5 wide requires better understanding of market direction, right? So you have, when you have wider spreads, as long as your premium, if you focus on your premium being around the same, the wider the spread, the further away you are going to be from the market. Okay, that's just how it is. Okay, so we talked about that. All right. Premium should be around 35 to 70 cents. I usually get 45 to 55, and that's really the area of premium that I go for. Okay, when I put on these trades, and I use today, as of today, I use a 10 wide spread. Okay. Take profit. You can use 20 cent for range bound market, 10 for trending market. Right. So if it's trending. Well, if it's trending away from you, obviously that's a good thing, right? And you can probably get away with even letting it expire. But even this past week, let me see, what's today? Today's Thursday. On Wednesday, right, the market moved down quite a bit, and it was sitting, my spread was sitting at 5 cents almost the whole day, until the market went down very quickly, and I ended up getting out at 25 cents, right? So, and it actually breached my position and then went back up. It happens, okay? So, so the best thing to do is to close the trade. However, if you're really far away, it's a lot of times it's pretty safe to let it expire as well, okay? Okay. So expiration for a 15 wide spread, and getting the direction right, you're good to go on that. All right. And then the stop loss, market moves immediately against you and aggressively. It's better to get out of that trade. All right. Okay. So let's go here. And breaks in support and resistance on the 5-minute candle. And I'll show you an example of that in a few minutes here, right? So you do want to identify support and resistance, and that's really what allows me to understand where I should get out and where I should stay in a trade. And we'll go through that in detail here, okay? So let me give you an example of one trade a while back, and I use this example just because to share what the market actually does, okay? And it doesn't do this all the time, but it does happen on occasion, on a good amount of occasions, all right? So I got into this trade, and I was using 5 wides, during this time. Had a 40 cent premium, okay? And you can see here where the market opened, I got in immediately, and it went down. It went in favor of where I was, of my position, right? Well, right after that, it moved to this area right here. Now you can, if you look at the chart here, you'll see that this area, there's resistance. Well, you can see it here, and you can see it here too, right? All these areas are areas of resistance. These are the same resistance area, and prior to the market opening, I noted this, in the futures trade. Okay, when I was trading, I wasn't trading futures. I was looking at futures, and the same area of resistance was found in the overnight trading, the overnight session. So I knew that if the market was going to continue moving higher, I was going to have to get out of this trade. Okay, and I actually, opened the position, getting ready to close the trade. Well, it stayed in this position and moved, it moved the opposite direction. It moved down nicely, and I actually closed the trade for 10 cents. Okay, but what happened after? So if you're a person that holds these trades, and through the rest of the trading day, you can see here where the market went, and this was at 3 o'clock. Okay, and a lot of things happen from 2 o'clock to 4 o'clock in the market, and so this thing went, it basically went high, pretty high here, right? And on the SPX, it was 29.90. Well, where was my position here? It was at 29.95. So if I would have held that, I would have been watching this thing, getting really, really close to a breach position, right? 5 points from it. And I guarantee around 3 o'clock, market moving up like this, the premium was probably $1.50, I would say, to $1.70. Okay, with a 5 wide around this time. Okay. Meanwhile, you had a 10 cent. You could have gotten out for 10 cents. And so what it is it? Time is risk. Okay, so just keep that in mind in your trading. I'm not saying that you have to close these positions or not let them expire, but you just keep that in mind in case that happens, and just be cognizant of it. It's a trade you have to watch, right? You have to be on top of. You just can't set it and forget it. Okay. Now I'm going to give you another way to look at these charts and what happens, all right, to these, and what keeps you in it, what may keep you in a trade that you may expire on you. Okay. So I got in again 40 cents on this position here, right? And I got in, and look what happened. The market just started moving up. Now this is a 1 minute chart, so it's the moves look pronounced, okay? But we were in a time where we had a high volatility, right? And I was pretty far away from the market. I mean, I opened the position at 28.25, and the market went up to, and the position was at 28.85. And so I was 60 points, or 65 points away, about 60 points away from the market. Well, it moved up, about 40 points, okay, up. But I was watching this, and if you notice here, you have a trend going up, and down here on the RSI, which is an indicator I use on every chart that I have, right? It was going down. So what was that? It was losing momentum. As it was going up. Now, yes, I was getting ready to pull out of this trade, okay? Again, but I wanted to see what would transpire when I noticed this characteristic here. And you can see here that the market was trending up, right, most of the morning. But when it got here and the market kept going up, we had a down move on the RSI. So I said, ooh, this is divergence, right? This is what's called divergence. And so I was able to stay in the trade, and this is a 5 minute chart of that same trade, right? And here's the high that it was earlier, and you can see the implied volatility high here in the morning, right? So it's highest in the morning when the market is opening, and you can see it trickling down, right, until towards the end of the day when it really started moving down. And notice here that we had higher, we had lower highs, right, as the market started moving down in this area. And even when the market was moving down, we still had volatility, stagnant until it started moving up, okay? Because towards the end of the day, you also have higher volatility as well. So I just wanted to share that example. All right, so now let's talk about 7DTE. And this is actually my favorite credit spread to trade, okay? And I'm going to give you a lot of detail on this trade because it's one that if you're just entering credit spreads, it's probably the best one. Well, the monthly is probably the best one to start with, but 7DTE is just really a non-stressful easy trade to manage. All right. And so I've gone through iterations on my trade plan, and this year I've really been able to nail it down. Okay. And what I do is I enter with smaller positions. I would enter with, before I would enter with bigger positions. Volatility is high. Let's get in right now with a good sized position and let this thing ride, right? Well, what I do now is I stagger my positions. Instead of putting them on one day, I may put one on Monday. I may put another one on Wednesday. I may put another one on Thursday, right? I stagger them so that, and stagger them with different expirations, right? So I'm not managing one big trade that I have to adjust and readjust, with that kind of diversity in the trading, I'm able to manage this much better with staggering the position. Okay. Okay. Again, you want to use volatility in your favor, and so real-time example here. On Wednesday, we had the market going up until the close to the end of the day, right, where the market went down. I was looking to put on a 7 DTE trade when that market started going down, but I wanted to wait because when the market closes near the low, right, there's typically follow through the next day, whether it's up or down. Okay, the market closes higher, the market continues. There's follow through to the upside. So the market closed near the lows of the day, and so I said, I'm going to wait until the next day. And sure enough, the market did go down further, right? But it's I looked at the indicators in the market on yesterday, and I said, ooh, perfect time to put on that 7 DTE, and that's exactly what I did. I put on the 7 DTE right at the market open, right when the volatility was highest, right? And this was on a Thursday. I put this on. I'm sorry, was it Thursday? Yeah, it was Thursday. What's today? Today's Thursday. Okay, sorry. I put on this trade this morning. Okay, so I put on this trade this morning, and I put it on for 60 cents premium. I got the order in for a 60-cent premium. Let me see. Yes, 60 cents. It was filled. I had it filled at 9:38 this morning. Okay, it was a 32.50, 32.40 spread. And today, right now at this moment, or at the market close, it was worth 35 cents. So in one day, I gained pretty much 50 cents, and at some point it was 30 cents today. I was watching it today. So I gained almost 50% of decay in that trade, just using market direction and volatility. Yeah, the market was in my favor. It went up, right? So, but even if it didn't go up, it was okay. It's a trade that's safe because it was 100 points away from the market. Okay, so that's a real-time example of 7 DTE and how it works. And I usually close these out in 2 to 3 days, right, when I put them on. Okay, so I use a delta of 10 to 12, and this is exactly the same thing for the monthly, for the bull spreads, and 7 to 10 for bear spreads. And I can tell you right now that I am only trading bull spreads, and the reason is because we have so much liquidity in the market, and it's just very, very bullish. There's no reason to put on bear spreads on this and make the mistake. And typically, a bear spread is going to be closer to the market than a bull spread. Okay, all right, and so I take profits 50 to 80% of the credit received, and I usually take 80%. Okay, but I do allow for 50%. Positions that have been rolled or adjusted, you want to target those for 20 to 50% because you always roll a position, and they're typically closer to the money, just because you want to collect that premium. Okay, in a market that's getting to be lower volatility, I trade them with 20 points away. I roll them when they're 20 points away or threatened, and when there's higher volatility, I use like 40 to 50 points. Then when I roll these positions, and I don't wait. Okay. All right. Stop loss. I really don't take stop losses on these, and I can tell you, except for since April, that I've been really trading my new trade plan, I've only taken one loss, and when it was for a call credit spread that I just, was like 10 or 20 cents that I took a loss on. I just thought it's just not worth it to stick by this thing and roll it when I can just get out for a small loss. Okay, and I did that, and that from that point on, I really have been initiating only bull spreads, and I haven't had one loss on those. Okay, they've all been gains. But okay, so I want to take you through an adjustment process. Okay, and this is an iron condor that I put on, and you can see here that the premium that I got was 85 cents for both. Okay, and so the next day that I put this on, the market moved up against me. All right, and so I immediately, it hit the 20 point bound there, and I rolled the call spread up, and it cost me 35 cents. But at the same time, I rolled the bull spread, and I got a 30-cent credit. And when I rolled that, all right, and you can see here that I only had to roll at 10 points to get the 30 cents, but the where I spent 35 cents, I rolled it, and it was 20 points higher. All right, I wanted to get a safe distance from the market. Well, at the end here, the market stayed within the right range. Okay, and I end up closing the position for 20 cents, and so. In summary, basically, I collected 85 cents, paid 5 cents to roll it, and collected 60-cent profit at the end. Okay, so this is a pretty typical scenario for 7DTE in an iron condor, and how you would manage the adjustment, right? Okay, so I want to take you through. Okay. Yeah, I'm going to take you through my April trades, and I can tell you that this can be replicated. This was replicated in April. I use iron condors. After April, I started using mostly bull spreads. Okay, but this is how I managed the April trades. All right, so started out on 4.7. I put on a bull spread. Okay, 2015. A couple days later, market direction, closed that trade, right, for 45 cents. The next position I put on was the 2610, 2605 bull spread. Okay, and I also put on a call spread. I closed the bull spread for 5 cents a couple days later. Okay, gained another 45 cents. Profit, and then I put on another bull spread a few days later, right? Closed that trade for 15 cents and gained another 35 cents on it. Okay, a day later, I rolled one of the trades. It cost me 15 cents, and then I put on another trade for 55 cents premium. Again, I had to do another roll here, right? It cost me 35 cents to roll it, and then I put on a couple more trades and closed one trade for another 30-cent gain. I know this looks like havoc, right? But if just think of it, it's a month-long process, that I went through. Okay. So I put on another bull spread for 65 cents, and I closed 2 positions on the same day, right, for a 10-cent profit. That's the one that I rolled, and for a 40-cent profit, okay, one that I didn't roll, and I was able to close. And then I put on another bull spread, and I closed the bull spread for another 50-cent gain, right? So all in all, I made $255 in premium that month just on 7DTE, and no stress. Rolled it, as I had to, and the ones that I put on here basically closed out for in the same fashion. I didn't have to roll these, but I did close it out. So that's basically what I did in April, and if I take it, if I take the rest of the months, again, I didn't have one loss in 7 DTE. And to me, it's just the best trade for credit spreads that you can have. Okay, so let's talk about the monthly. Okay, and in the monthly here, I'm gonna share with you how a monthly adjustment is handled. Okay, as opposed to the 7 DTE. Okay, so I put on these every 30 to 60 days prior to expiration, right? And I try to use high volatility. Okay, I have one on now, and it's a bull spread. Bear spreads are you really should enter them cautiously, and it's just not worth it in a market that's going relentlessly higher like we have today, right? So I'm putting on mostly bull spreads on this market. I use a same delta as I use for 7 DTE, and 7 to 10 for bear spreads, right? I want to get it away from the market as much as possible. Take profit, same thing as 7 DTE, 50 to 80%. When you have to roll or adjust them, you want to be, you want to take profit 20 to 50% of credit. Okay, same reason. It's also acceptable to allow them to expire worthless as long as you're far away from the market. When I put these trades on, I always set a take profit at 0.05, and I just leave it out there. I just leave it and good till canceled. Okay, and I just closed one, from last month for 5 cents because today was expiration day, right? And tomorrow is it settles in the morning. When I roll the trade, I wait for in low volatility environments 2.5 to 1.5% in a higher volatility market. It's anywhere from 5 to 10%. Okay, that I will roll a position, to keep it safe. Stop loss, the same thing. I always roll these trades. So let me give you a real example of this monthly trade. You can see here when I put on this trade, I got a 35-cent premium for both, and these are 5 wides. And you can see here where on the put side you have a lot more distance than you have on the call side, right? That's by design. Well, the market, moved against me, and so I had to make an adjustment, right? And here's the adjustment that I made. So the first thing I do is I close out the non-threatened side, right? And the reason you do that is because if you roll the non-threatened side, you're going to use twice the margin on it, okay? So I close it out, and then what I do is I roll the threatened position. And so in this case, I rolled it for a credit of 0. Basically, it cost me nothing, to roll it other than the commissions. And you can see here where I rolled it to almost 100 points. It was about 80 points, right? Yeah, about 80 points away from where it was previously, and I use a debit of 0. All right. So here's the actual trade itself. It's a vertical roll when you're going from one month to the other. If it's in the same month, it's actually a condor trade. Okay. And then what I did was I took the position that I closed, I moved it lower, and I got a 50-cent credit for that position. Okay. So basically, I got a credit of 45 cents to do that. So the adjustment credit, 0 plus 45, it was 45 minus commissions, and the premium collected was $1.15 total. And I ended up closing that trade for about 20 cents at the end. And so it actually favored to do the adjustment, in this case, right? And so I ended up on the adjustment with still, you're being a little close, but the market, had a reversal. It went down quite a bit. It had a reversal, and I was able to get out pretty nicely. Now, if it goes against me again, you have to do the same thing over again and move it. And the key to adjusting these trades is to do it early before you get very close to the threatened position. All right. So let's talk about some quick technicals before we get into futures on how I manage them in 0 DTE. This is a Fib retracement. Okay, and I'm going to talk a little bit more about fibs in futures, but this is a Fib retracement. So it's a drawing tool that Thinkorswim has, And so you go from the high to the low, and that's your retracement. And so what you're doing here is you're measuring, where the, how far the market reverses after it reverses. And there's key points in these areas. So you can see here where in down market, let's say, right, not in range bound or trending, but if the market was trending down, you would see a reversal, maybe go to the 23.6 level or the 382 level, and then continue going down, right? But this is a pretty good reversal because it went up to the 786 area. And then started falling back. Usually if it breaks the 786 area, it'll continue moving higher and break the high as well, just because it has that momentum. But I was in a trade here, and you can see where the 5-minute candle broke and it went back down. This happens a lot, all right? And so what I do is I like to wait until the candle closes before I close out the trade. And so I did it in this fashion, and I was able to hold on to the trade for a gain. Again, here you have a market going up, and the MACD here shows momentum losing in the trade, and so that gave me a little more confidence too that I should stay in the trade. Okay, quick example of using fibs. Support and resistance. You can see here where the market goes down. Price resistance is much stronger than trend line resistance, and so I really focus a lot on price resistance. And so here what happens is the market stays, and this is an hourly chart, so it stayed in this range, right, of this area of support for 3 days until it finally broke. It broke, and what happens? Support now becomes resistance. So you're under it, and so you can see here where the market struggled to get up, took a couple days, and you can see here it broke here, and then it went back, and it actually broke and reversed, okay? So important to understand how to recognize support and resistance, and you can see it in a trending fashion too. So in this case, right, you have support in the trend line, and that's how you can read support and resistance areas in the market, right? Okay. Okay, so let's now talk about futures. All right, I'm going to take you through a lot of charts here, and just keep in mind that this was 8 months of testing and research for me, okay? So you're not going to get it right away, okay? So let's break down futures real quick here. So I trade two types of futures: MES, which is the micro future for the S&P 500. The multiplier is $5 per point on the S&P. Ticks are a quarter of that. And the dollar value of one tick is $1.25. So it's, you do the math, it's $5, right, for point. Micro future for NASDAQ is the MNQ. This one is much more volatile, okay? Contract multiplier is $2. Tick is the same as MAS. The dollar value of one tick is 50 cents. So it's basically $2, right, per point. And margin requirements are higher for MNQ than for MES, just because it's a much more volatile instrument. Okay. All right. So those are the basics. So let's move on to things that I use to trade futures. Right. And so this is an example of a futures IB area, IB range. Okay. And you can see here in the IB range, what happens is that it's the high and low of the market within the first hour of trading, right? So these levels actually create support and resistance levels as they form in the market. Okay, they can be used to establish trading entries and exits. And what typically happens is that it will break one of these levels, move back, creating a reversal pattern, just like it did here, right? And it's tradable. It's basically a tradable event. This is a 1-minute chart, okay? Here's an IB trade. This is the 5-minute chart, same chart, right? You can see here where it broke in the morning and went back down, but it broke above it, and it actually stayed above it for a long period of time, which I thought was interesting. So what happened was, once it broke, this area of resistance became support, right? These are patterns that happen all the time. And so when it came back, though, it broke down, and then once it broke IB, the IB range high, it continued moving down to the IBL low, right, to the IB low, where yeah, it broke through, but it reversed pretty aggressively right after that. So these are strong, strong ways that you can use to trade futures, in mostly scalping. Okay, so and I do scalp from time to time, but I mostly do swing trades. All right. So let's talk about finding a bottom, because that's really, really important. Finding a top is much more difficult than finding a bottom for some reason. And I think it's because the market is generally trending higher. And so let's dissect this a little bit, right? So here a bottom formed, and a reversal. And this happens time after time after time. You get a test. You get that test, so you almost always get a test of what of your bottom. It failed, so now we have another bottom. Went through, a move up and then a move down. You had a test and it failed again, right? Have another bottom. Test and it failed again, right? So now what happened? Now you have another bottom again. So here, it went for a longer period of time, and it's funny where it stopped. It stopped at the IB range low, the low range of the trade day. And what happened? It tested, but it didn't break the bottom. Okay, and so now you had a test, and now you have a reversal, right? And then with that reversal, you'll get a confirmation, and this is where you want to enter your trade, right? This is where you want to enter. Now, I'm telling you, I sometimes want to go in early. So I go in early, put a stop in, boom, I get stopped out. And I may have 2 or 3 stops, right, before I actually stick with the trade. So let's look at this now on another note, right? Now look at the RSI here, right? What's happening? The market's going down. The RSI is moving up, okay? And I'm watching this. This is called divergence, right? We talked about that already. So this is another indicator to say, hey, it's losing momentum here. Get ready, because this might be a good time to trade. And you might want to get in early because you can see, your diversion here already, right? And you can gain on this, gain on this trade, put a stop in, a trailing stop, right? And let it take you out, okay? And you'll make some small gains over and over again. But you want to make sure that your commissions are low. If you're using Thinkorswim, they're not low, but I use Thinkorswim because it's integrated with our signal service. Okay, so here's the same chart, MNQ, but 5-minute. Now you can see here, this was the test of the bottom right here, right on the 1 minute. And you can see after that test, look how far it went, okay? So we had, what did we have? We had higher lows here, right? And then higher highs here. Very typical pattern. And so you could have got in here where it was safe, held on, not gotten out, right? Until finally it broke into a lower high here and a lower low here, right? So you could have gained, a certain amount here from here to here, right? But if you use targets, right, it's much better. So this is a Fib retracement, and the best way to use Fib retracements is to set targets. Typically, a target is set, and you saw it in the other chart, right? This chart, once it reversed, it went up to the 786 area. 618, 786, very typical area where it will go to and then start failing again, right? Once it breaks the 786 area, you might as well hold on because it's probably going to go right through and break the high, okay? And so, again, these are typical patterns that I use to trade futures. And if you do this consistently, you recognize these things and it becomes innate, and you make money over and over again on these guys, all right? But you have to really understand and use these tools together so that you understand how to use it. This is the same chart, 1 minute chart, okay? So that you can see the pattern here, a little more rigid, or more rigid, more volatile, right? With the 1 minute, and that's why I like to use the 5 minute. All right. Here's another tool that I use. It's called a Fib Extension, and this is what I use for my swing trades, and that's what I mostly trade, is swing trades, right? So this extension, it's not a retracement, but it allows you to use fibs in an extended way so that you can target areas that you want to hit. All right. Usually in an AB, this is called an ABCD pattern, right? And so there's A, there's B, down to C. Okay. A is going to be lower than C, and then the fib will create these extensions here, right? And it's the D pattern. That's where you want to get out, between the 100 and 125, okay? Now what happened? I was in MNQ, this particular trade. Is this MNQ or MAS? They were similar. 33. This was MAS, okay? So what happened was it came up here, right? And then it broke, and it broke, you know, on Wednesday, it broke down to here. But as long as it doesn't take out my low, I'm fine, okay? So it went down here, it actually broke this a little bit. I stayed in the trade, right? I was negative, and I stayed, but this is a swing trade. So I stayed in the trade, and once it went above again, it went above this area. It hasn't gone above this area yet. I don't know. I haven't looked, but I'm waiting for it to hit this area up here to take a hit, to take a gain. All right. I used the same extension for MNQ, and I got out of the trade today at a very nice profit, right? Using a Fib extension, using an ABCD pattern. Okay. All right. I know it's a lot of information, and I packed it in, you know, but I wanted to share it with you so that you can go back on the replay, hopefully listen to it, and start doing some more studying and fashion your trades this way. Or, you know, you can actually follow my trades while you learn the 4 strategies I've outlined to become a consistently profitable trader, right? And so, again, let's talk about while you're here. Interested in learning new strategies, not seeing your account grow, not finding the right strategy, you know, how do you break those barriers? Okay. And that's what I want to talk about now. So the question is, do you want to keep doing what you're doing and hope that someday that your strategy will stick? Or do you want to take the real steps as a trader, right? And get to a place that works over and over again consistently. It took me years to get there, right? But I got there. It's learning, training, instruction, practice, success, but it's not only that. It's discipline, it's commitment, it's having an edge, right? Or multiple edges, and having a no-quit attitude. So I say all this because in the end, what we really want is to be successful, right? I mean, we all as traders want to be successful traders, and in order to do that, you know, we need to encompass all those things that I just mentioned, and making sure that we have as many, you know, as much of an edge or as many edges that we can possibly have in order to beat the odds of success here in becoming a consistently profitable trader. Okay, so where does that lead me? You know, when I started out here with the Facebook group and you know, working with a lot of traders, I did a lot of individual coaching, you know, and you know, decided to move in this direction where we can help as many traders as we possibly could. You know, we started this as a free group, and then moved more into a, you know, a much more professional and automated process in order to really put out the trade alerts that we possibly could. And what is it? What is SOS Trade Alerts? Well, it's an alert system that we developed, right? And the alerts are instant trade notifications, and they're set directly to your phone or computer. And they announce high probability options and futures trades for those who are seeking to generate consistent income and more dependable returns in trades. Okay. Additionally, whether you're getting started already,
you're already successful and ready to expand your strategies, our trade alert service is going to help you trade at your highest level. It's designed to transform your trading from uncertain to predictable and teach you how to generate consistent returns. And so I call it you learn while you earn. Okay. And so it's not only me in the service. I trade with another professional trader, and he puts out different kinds of trades, other than the strategies that we discussed. And it's just a great combination. He used to have a signal service as well, and we combined forces, and it's really worked out. Okay, so we also, just to let you know, we do use Telegram because it's very secure, it's instant, and it's just a very good platform to use to get these trade alerts as quickly into your hands as possible. Right? We talk about fills and profits. What profit area we're going to take the trade alerts out of, etc. Okay, so the service has two different types of channels. One is for one-way communication, and that's where we put our alerts out. Okay, so it's either me or Ike sharing this, and there's no interactive discussion in between there. Now we do have chat groups, two chat groups. One is a live chat group which talks specifically about the trades that we're in, and the second one is a subscriber chat group where you as a subscriber, if you join, you can put in your trades as well, and share them with a group of other traders, and kind of we help each other out, okay, in that aspect. All right, so it's really geared to make sure that the trade alerts are very, very accurate and specific and easily understood. So we've automated actually my trades out of my account, and my trades show up in the channel within seconds. Okay, sometimes it takes a little bit longer, but usually it's within seconds that you can see what trade exactly that I made. All right, and it's very, very fast, very accurate, and it works very, very well. And we're continually improving this process. All right. So that's in a nutshell what the trade alert service is. At the moment, we're not taking in new subscribers because we open it up 4 times a year, and so every 3 months we open it up. And really the reason for that is we want to focus on our traders for the majority of the time. We have a window open for 2 weeks that we bring in new subscribers. We get them acclimated. We provide an orientation. And then off we go, and then our focus is for you, the trader, if you choose to trade with us. Okay, so here's some great success stories. I've worked with Matt for a lot of years. He joined the service. He trades primarily iron condors and the monthly trade, and loves the service, and really has done well and improved his performance a lot. Also, Winford was with us for a while. He was pretty aggressive, made a lot of money, and loved the service while he was with us. Okay, he's not with us any longer. He stayed with us for about 3-4 months, learned what he needed to learn, and took off and started trading on his own. Paige is a school teacher. So she trades on the side, and she loves the free money that she's getting on these trade alerts. Dwight is actually a CFO for a company. He loves zero DTE and thinks it's the most consistent and risk-free way of making money. Okay. Zero DT is a little challenging, but it is a day trade, and you're in and out in a day, and that's it. So in addition to these success stories, I also offer a guarantee. Okay, and the guarantee is that if you subscribe for 1 month and lose money, I will provide the subscription fee back to you plus 25%. That's my guarantee. And the great part about this for me and for the traders that we trade with is that I've never had to come good with the guarantee, because no one's asked for it. Okay, they always make money. trading with our trade alerts, and they're very happy with the service. All right. So with that, you're probably wondering, okay, how much does it cost? Well, here's the regular fee, or the regular price, the monthly charges for the different types of programs that we have. We have a swing trader, day trader, and full-time trader. Each carry their own different types of trades, and one builds upon the other. Okay, so with the swing trader, you primarily get Ike's trades along with monthly trades that I put out there. With the day trader, you get in addition to those, you get 0 DTE and 7 DTE trade alerts. And then for the 129 plan, you also get futures trades that I trade. Okay, but now if you do choose to take us up on this subscription service, we do offer a discount for life. Okay, and so these prices here are actually $20 off for life, right? If you choose to do it. So we're putting up the offer right now on the window here, and you can click on it, and it'll take you to the page where you can register. Now, not asking you to sign up at this time, just to sign up on the wait list. The wait list, we have the wait list just because we want to make sure that we don't have way too many people joining at one time, and it gives you the opportunity to join early so that you can take advantage of the bonus, the $20 for life bonus, by joining. Okay, just by joining the wait list. There's no obligation, no credit card, nothing. All you need to do is sign up, put your email in there, and then once we open the service, you'll have first dibs to get in. Okay, that's basically how it works. All right, so I went over the pricing. I went over the the success stories. So the question is this for you? If you want to learn a step-by-step process to gain income in a market that goes up and down, right? You want to finally break those series of losses and account drains, right, that we've all been through, okay? And you want to earn consistent income that sets you apart from other traders. This is it. This gives you the edge, the added edge that you need to be a successful trader, okay? And I can tell you that from all those that have worked with us, right, they're very, very happy with the service, and they love it. Okay, so you do get $20 off if by subscribing to and joining the wait list. And again, you're not really subscribing to the service at this time; you're just joining the wait list. Okay, free of charge, right? You get professional traders chat group and subscriber chat group. You also get training, education ad hoc. As we put on these trades, we get a lot of questions and are able to share, what we do, our charts, etc., in the group. So you're actually learning and not just taking these signals in, all right, or these trade alerts. The automated signals, as I mentioned before, they come in within seconds of the trade. They come directly from my account. We provide entry fill price, price target after fill, and my guarantee, and it's a sure recipe to win. Again, my guarantee, if you don't make money the first month, I'll return the subscription fee plus 25%, and you can't go wrong with that kind of guarantee. All right, so hopefully you enjoyed the trade session, the workshop, and you got some value in it. Even if you don't join the service, hopefully, again, you learned a lot here, and I really do hope to see you. And again, no obligation. It's a no-brainer for you to join the for you to join the wait list, and we look forward to trading with you and seeing you in the future. All right, thanks, and have a great day.